Hey guys, welcome back. And in today's lesson, we are going to learn about the US dollar index and what that is. So, first of all, an index. If you have heard obviously of the Dow Jones Industrial Average or the S&P 500 or the NASDAQ, then you're familiar with an index. And what those are is like the Dow Jones Industrial Average is an average of 30 companies from different industries that approximate the entirety of the market. So instead of just analyzing one company with an index, you get a total of several companies. So in the Dow Jones, it's a compilation of 30 top companies in certain sectors, and in the S&P 500, it's a compilation of the 500 most strongest, the 500 strongest companies. And with the dollar currency index, you get it's a relative strength of the US dollar versus several different currencies. So, it's really similar to how stock indexes work. So, instead of different companies, the US dollar index, also known as the DXY, so you'll type in DXY on your chart, and it'll give you the US, obviously the currency index. And it consists of 6 foreign currencies. It consists of the euro, the yen, the pound, the Canadian dollar, the krona, which is Swedish currency, and the Swiss franc. So, what we have and why this is important is because the US dollar is the king in the market. It basically controls what all the other pairs do. So, what that means is you can see that the US index is rising. So it's been rising since about 2018, and in the past couple of years, it's been in this ascending channel here. And what this has done across the currency market has caused different currencies to react to that. So what I mean is that as this US dollar currency goes up, everything with the US dollar on the second half of the pair would have been going slowly down. So, what I mean by the second half of the currency pair, for instance, the euro USD. Would be one example. And you can see that as price on the DXY was going up, this was dropping in a similar fashion. So we can look at this and then switch over quickly to the DXY. And you can see that there's an undeniable correlation between how the US dollar affects that currency. So it's not a fluke. Let's look at the Aussie USD. And we have the same thing. As the USD was slowly pushing up, this has been pushing down. Let's look at the New Zealand dollar USD. Again, as that has been pushing up, let me clear off my drawings here. This has been pushing down. Now, if we look at the opposite of that, if we look at pairs that have the US dollar in the front of the currency, we'll look at USD CAD. And again, we can see it's been slowly rising. In a similar fashion to how the DXY has been. Let's look at the USD Swiss. Again, this one has been a little bit more stagnant, but in total, you can see it too has been pushing up. Going back to the DXY in a very similar fashion to how the DXY has been doing. So it's critical that you're able to properly analyze the DXY and get a good idea of what the US dollar is going to do, because that's going to affect all other currency pairs that you trade. And it can act as a point of confluence as well. So let's say that you're marking this up and you think that you're going to get a sell right here. Okay. So let's say you're waiting for a sell to happen in this zone that we've got here. Okay, you've got everything marked up. You're waiting for price action to give you a sell. So let's say you've got a sell marked up here, but on Euro USD, let's say you also have a sell marked up for Euro USD. Maybe you think it's gonna do something like, break out and then correct and then, keep going down and follow this trend. Let's say that's your prediction for this. Well, one of those predictions is going to be wrong. Because if you think this is going to happen, let's say you think we're going to push down into this zone here. If that's your prediction, then your DXY prediction needs to be similar to that. Your DXY prediction needs to have you coming up to this area. And basically just doing the opposite, breaking this zone, coming down, oops, and then continuing up to here to follow that. So it's just a really good way to have extra confluence on your trades. So just make sure that your DXY matches up with what your other trades, with what you're expecting from your other trades. And how I personally use this in my trading is I will analyze the DXY first to try to get a good idea of what the US dollar is going to do. So if I think it's going to sell, I want to look for pairs with USD in it that are looking to buy. So if I'm predicting a sell here, then I need to look at Aussie USD and see if we have a possible buy setting up here. Okay, and we very possibly could, because we're coming into this area here, which seems like a pretty strong zone. We'll put our trend line here. So it might push down a little bit more, but in general, we're going to be looking for this to break, retest, and then continue upward. As long as we still think that the DXY is going to sell. So if we think the DXY is going to sell, Aussie USD is going to go up. NZD USD is going to go up. Great British Pound USD is going to go up. Anything with USD on the backside of the currency is going to go up, and vice versa. Anything with USD in the front will go down in a sell and will go up during a buy. So that is the basis of how we use the DXY.